Well, thank you very much, Professor Kim, for that introduction. And thank you also to IGE and Hana Bank for the kind invitation to speak at the conference today. It's a great shame that I'm not able to take part in person. It's always a pleasure to visit Seoul, and I would have loved to have had the opportunity to visit Seoul again. Unfortunately, because of the travel restrictions, I'm not able to attend on this occasion. And the fact that I'm taking part through this video link, I think is an indication of how the world has changed as a result of the coronavirus pandemic, and how that is changing the way that we live and work. And that is the subject. I have a very brief presentation, which I'd like to share with you. That's the subject of this presentation. It's based on a report that we at Moody's published last week, where we did something slightly unusual. Most of our research is focused on a relatively short time period ahead. So we generally look 12 to 18 months ahead in our research. But what we wanted to do on this occasion was to look at the impact that the coronavirus can have on the way that the economy functions, the way that we live and work, and what that means for credit over a longer period of time. And I'm just going to share my screen with you now so that I can just quickly take you through the presentation. So this is based on the report that we published last week. We called it Credit After COVID because the whole intention is to focus on how recent developments are going to change the way that we look at credit and how credit impacts our lives. And we see this as being a crisis of historic proportions. It is going to result in fundamental shifts in the way that economies, societies, companies operate. And what we wanted to do is to think about what would the new normal look like. And I think some of the topics that we've identified are the ones that have already been talked about today. And so I'm not going to go into those in a lot of detail. But what we decided was that there were 6 major trends that we saw as being important from the point of view of credit in the post-COVID world. And those trends, in each case, it's nothing that's new. In each case, it's an acceleration of a trend which is already happening. And those 6 trends are that we expect long-term growth to weaken across many major economies. In effect, the coronavirus crisis is going to inflict lasting damage on the economies of many major economies in the world, and that it will leave some permanent scars on those economies, and that will mean weaker growth in the longer term. Secondly, partly as a result of that, we expect interest rates to stay lower for longer, and indeed for longer than we had previously anticipated. We're expecting that global trade will become more fragmented, that there will be some de-globalization taking place, as we heard from Tim Adams earlier, and that as a result, we will see, again, some decline in terms of the long-term growth potential across a number of major economies. Consumer habits, we think, will change permanently, and that will lead to accelerated disruption as a result of adoptions of new technology. And that will have different credit effects across different sectors. Some sectors will obviously be quite affected and negatively by that. Other sectors will see some positive gains out of this tech disruption. As we've also heard in the other presentations, we think that governments are going to have to take on new social mandates in response to increased concern with the availability of healthcare, in terms of greater concern with social inequality, and that will feed through to the way that governments function in society. And also, as we're seeing as part of the support packages, that governments are taking ownership stakes in major companies, such as airlines, and that will also change the way that governments have operated for the past 30 years. And then finally, we think that, and as again, I think Sonia Gibbs emphasized this in her presentation, we think that environmental, social, and governance issues, ESG issues, are going to come into greater focus for investors, and their credit relevance is going to rise. Now, I'm not going to go into all of these issues in a lot of detail because obviously we're quite short of time. So let me just pick out a few which I think are most relevant, particularly from the point of view of the financial sector, which is the sector that we're discussing in this panel. In terms of the weakening of long-term growth, that will obviously have some negative effects for the financial sector. From the point of view of governments, we're expecting to see higher fiscal deficits over a fairly long period of time. Deleveraging, both in the public and private sectors, will be delayed. We'll see slower corporate profit growth. All of those factors will have negative effects for the financial industry. And indeed, financial industry profitability is going to be negatively affected by the second major trend, which is that interest rates are going to stay lower for longer and longer. So what happens as a result of that is that we'll see a looser credit environment, greater availability of credit, more liquidity. We'll see highly leveraged companies able to cover their interest payments more easily as interest rates stay low. So we'll see improved interest coverage, but leverage across the whole economy and across many sectors is going to be higher. And a third implication is that we'll see more zombie companies. That is to say, companies which cannot cover their interest payments from their current cash flow. And the restructuring of those unviable companies is going to be delayed by these lower for longer interest rates. That will have macroeconomic impacts in terms of a slower rate of economic growth, productivity impacts in terms of the economies becoming less efficient, but also it will have implications for financial companies too, because again, for banks, the credit soundness of their borrowers may well be lower. We may see at the same time higher potential default risks in the event that there is another economic downturn in future, given these poorly performing, highly leveraged companies. While at the same time, we'll see asset price inflation as a result of these lower for longer interest rates. So all of these factors will have negative effects from the point of view of the financial industry's credit quality. I'm not going to go into detail in terms of global trade because that has probably less direct effects for the financial industry. But let me move instead to talk about what changes in consumer habits will mean in terms of financial industries as well. And there, the big impact is in terms of tech disruption. Again, in line with what I said about the way in which the coronavirus crisis is accelerating existing trends, then we expect to see it leading to a greater embrace of fintech. We've already seen the much broader adoption of contactless payments, for example. Although I think in this part of the world, in Asia, that's been much less of a change because we've had contactless payments in this part of the world for a long time. But certainly in Europe and North America, it has greatly accelerated the move towards contactless payments. So we'll see more services moving online. We'll see a greater role for fintechs. And that will be positive for the fintechs themselves, for IT companies, for artificial intelligence. And the real losers in this process, not just in the financial sector, but I think in the corporate sector more generally, are bricks and mortar retail, areas like public transportation, traditional media, and entertainment. Moving on to the last two issues that we identified. First of all, governments, we think, will have new social mandates. Social safety nets will need to be strengthened. This will be a demand of populations, voters in many countries as a result of this coronavirus outbreak. That will mean changes in terms of spending and revenue priorities. It may also lead to an increase in support for national champions. I talked earlier about governments taking equity stakes in companies. So we'll see, I think, greater promotion of national champions. And certain sectors will attract greater regulation, perhaps not so much in terms of the financial sector, as long as we avoid a major problem in that sector. And as again, Tim Adams has explained, regulation over the last 10 years has strengthened quite considerably around the financial sector. But there are other sectors which may become more highly regulated as a result. And I think particularly here, it's the role of big data and the increased recognition of the importance of big data will start to result in higher levels of regulation of companies which have access to large amounts of data. And then finally, ESG, we think will come into greater focus. Again, it's an acceleration of an existing trend. But I think, again, from the point of view of the financial sector, one factor which could again have implications is this last point in here about the shift towards a multi-stakeholder approach to corporate strategy. So less emphasis on shareholder value as being the chief objective of management, and a greater recognition that there are other stakeholders whose interests also need to be balanced. And that will change the way that companies, particularly financial companies and other companies, will operate. We'll see more emphasis, I think, on things like risk management practices, a greater preparedness or a greater attempt to prepare for large unexpected shocks, building more resilient systems, building a greater ability to respond to these high impact global events. So that, in summary, is how we see the impact of the post-COVID world. It's going to be a world with lower growth, lower interest rates, greater challenges across many dimensions for companies and for financial sector companies. And it will be one in which we will see some erosion of credit quality over time. So with that, let me hand back to Professor Kim, and thank you.